cloud. Okay. All right. I think we are recording. Did you all get a notice that we're recording? Perfect. All right. So one of the things I want to lead off with, and you see this on the cover page of the presentations, is this scale of, the heart being the mission, and then on the other side, it's the dollars being the money. And this is something that is just, you've heard me talk about it a little bit, but it is just so integral to financial management of nonprofit organizations. It's worth taking another minute just to dive into it and really get a clear understanding of what this means and kind of where some of the tensions reside for nonprofit leaders. It's something that I live and breathe really almost every day in the work that I do as a chief financial officer. Um, the most tangible example that is top of mind for me that I want to share with you is that I'm actually working on a Berkeley Haas case study. So I did one about 10 years ago, which we will take a look at together, synced up to the Affordable Care Act. But given that the Affordable Care Act passed almost 15 years ago, the case itself is a little dated in terms of the context. In terms of the content and looking at, the viability around growth opportunities, those core issues are still relevant. It's just that the Affordable Care Act is not really a hot topic anymore. Um, the second case study that I'm actually in the middle of right now is the launch of Lifelong's Berkeley Trust Clinic. The Berkeley Trust is a homeless clinic. And the need in the community, in the Berkeley community, is really significant in terms of providing healthcare services for the unhoused population. Really critical work. The question is, how do you build a clinic like that in a way that allows it to be sustainable over time? And the case is really focused on the financial modeling work that we did, right? Where we built out a financial model to get it to a place where at least we had a clear understanding of the levers that could optimize the model. And a lot of that had to do with how many hours the clinic would be open and how we staffed it. Those are the big things. But even in a best case scenario, it still wasn't break even, right? The projections show that the clinic would still be losing money, which, as we've talked about a couple weeks ago, means that um, the fee for service that's generated through Medi-Cal and maybe a little bit of Medicare doesn't actually allow the ends to meet for that clinic. So therefore, some form of philanthropy of fundraising is required and will probably be required in perpetuity for this clinic. So the takeaway on all of this um, really has to do with this notion that we'll talk more about, which is just because a program is deficit producing doesn't mean that we cut the program. What it does mean is that we understand how much subsidy is required to continue the program and to make sure that we have visibility into where that subsidy is going to come from, whether it's funded internally, whether it means additional fundraising efforts, things along those lines. So the point really is you want to make it as good as you possibly can fiscally, and you want to do it without, really pushing up against the core mission of the work that's being done. So what does that mean? So in Berkeley Trust, right, we could make it profitable if we really scaled back a bunch of different positions, right? But if you scale back on those positions, then the quality of care is going to be impacted because you don't have the staffing model in place, right? So this is the tension that nonprofits deal with, right? This is the management issue of financial management, right? What we're going to spend time talking about today, once we get past some of the kind of the overview stuff, is looking at the financial statements. The financial statements are outputs, right? They're data points. It's like information that you see on the dashboard of the vehicle to kind of get a sense of where you're healthy and where you're struggling. But I want to provide this introduction because I want you to hold all of the financial information we're going to start to go through and all of the ratios that we're going to start to look at really is just indicators on the dashboard. And to avoid the urge of saying, hey, this is good and this is bad, even though 4 days of cash on hand is not really good, right? And 100 days of cash on hand probably is. But the main point is really understanding from a mission-based business, if a line of business is running a loss, we might still continue to do it because it's something that fulfills our mission. And therein lies this inextricable link between the money and the mission, and that inevitable tension that resides there as well, right? So as managers, it's about the awareness, and it's about the trade-offs, right? And making sure that if there is a line of business that requires subsidy, to ensure that that line of business, you have visibility in terms of how you're going to cover the gap. So more on that, but I wanted to provide that introduction because I don't want to look at financial statements in isolation. I want you to understand the sort of how we make meaning out of it and how it becomes important for organizations to do really important work in their community and also be sustainable over time. And sometimes there are organizations that have to make a decision to say no to certain things. And that's a tricky one, right? There's a huge need in the community. There's an unhoused population. And there might be limitations in terms of how we serve, right? So that's my little intro. Let's start talking high level first. So in terms of nonprofit background, right, there are, that shouldn't be a dollar sign. Hold on, this is annoying to me. I'm going to fix it. Save it, current slide. Can you guys still see? Okay. So there is an excess of 1.6 million nonprofits in the United States. That's a lot of 501c3s. Of these 1.6 million plus nonprofit, it actually employs about 10% of the US workforce, right? So while that's a relatively small percentage, that is not an immaterial number of US workforce that's being paid by a not-for-profit corporation, which means there is a charitable purpose. The employers are divided up. Healthcare makes up a little more than half. Then you've got education. Then you have sort of social assistance, social welfare. And then the balance there is grant making, religious, arts, and other, right? So healthcare is the big one. When we talk about 501c3, right? So all nonprofits are exempt from income taxes, right? So that's a primary form of subsidy coming from the federal government, right? And the state government. Understand that, right? We're tax exempt, so we don't have to pay those taxes. All right. So, that's a nice feature to have. I wouldn't mind not having to pay taxes myself. That would bring in a whole lot more money for my family, right? So that's the primary, it actually is sort of the first form of subsidy that nonprofits receive. But it's only the nonprofits that have the 501c3 designation that can also receive tax deductible donations, right? So there is an incentive in the giver to give dollars to a 501c3 because that would be a tax deductible gift. The other thing that's really important, right? Lifelong medical, which I've talked a lot about. We are $140 million budget. We have over 1,000 employees. We're a large nonprofit, right? What's interesting to note is only 6.3%, right? A relatively small percent of 501c3s are 5 million or above, right? So of the $1.6 million, I'm sorry, 1.6 million nonprofits, the vast majority are under 5 million, right? The other thing to note is that while 6.3% of these 501c3s have $5 million or more in annual expenses, they also assume 88% of expenses, right? So you've got this cluster, a small percent of, larger nonprofits that really sort of make up the majority of the expenses that are out there. So what that also shows us is we have a lot of teeny tiny nonprofits that are out there. Why am I taking the time to talk to you about all of this? A few reasons. One is the focus of this course is the $5 million and up not-for-profit corporation. If you are a not-for-profit, a 501c3, and your annual budget is a couple $100,000 a year, and there are a lot of nonprofits out there that do incredible work on a shoestring budget like that, you maybe have an employee and a few volunteers. Because those organizations are so small, the financial management principles that we're talking about here don't really apply to them, right? So much of those small nonprofits are driven by sweat equity. It's about the passion of the individual that started the nonprofit and the work that they're doing out there. It doesn't make a whole lot of sense to talk to them about what their month of cash should be, right? It makes almost no sense to talk to them about accrual accounting or some of the core principles therein, right? That's not what they're there for. They're there to serve a mission. And once they're done doing that work, the organization will sunset, you declare victory and move on. That's great. The focus here is to say, look, among these $5 million and up not-for-profit corporations is that they are institutions embedded in their communities that play a critical role, right? If they weren't there, there'd be some kind of giant sucking sound in terms of the absence of services that are available for our communities. And my notion and what I'm sharing with you in terms of financial management is this idea that, if the decisions that we make today fiscally will affect the organization 5, 10, 20 years from now. And, the assumption also is that this is an organization that's going to be relevant to the community in 5, 10, and 20 years from now. So the decisions that we make today, we want to be thinking about not just what's right in front of us, right? If you're a $200,000 organization, you can kind of operate that way. Like, let's keep going until we can't go anymore. But with the larger nonprofits, there's a legacy factor, right? There is this idea that we're going to pass the baton onto someone else, and that we want to leave this organization better, both in terms of the services we provide and the fiscal health, than the way that we left it, right? If you believe in that, then what we're going to be talking about over the course of the semester becomes critically important, because you don't want to operate a $140 million organization in the same way that you're operating a $200,000 organization. I'm kind of going to extremes here, but I really do want to emphasize that. Like, if you got 1,000 employees and you're just like, you know what, we're just going to put it all on the line all day, every day, that organization's not going to stick around for very long, right? So we want to make sure that we're making smart decisions, that we're building the right infrastructure, that we're thinking about sustainability. All of those things are really critically important. Any questions? Okay, let me keep going.
No
Yep.
questions, but I think Pamela is texting me, and I think she's in the waiting room and she's asking.
I'm here.
Yeah,
Oh,
just
thank you.
thank you, Varda. Yeah, I just let them in. My apologies, I didn't see the notice until just now. Okay. So in terms of the not-for-profits that are over $5 million, there's, generally speaking, an org structure that you're likely to see. The naming conventions might vary a little bit, but generally what you're going to have, first and foremost, you're going to have the board, right? And the board of director oversees the CEO, or sometimes they call the executive director, right? So that's a key factor. Now, out of curiosity, how many of you all are board members, serve on boards of nonprofits? Anyone? Ariel, you do? There's probably a few others, right? Kobe? Okay. So one thing to keep in mind is that, as a official member of the board, you are a fiduciary, right? You actually hold fiscal responsibility for the organization. Part of your due diligence anytime you join a board is to make sure that they have directors and officers insurance. That's for your own protection. The odds of anything really happening are very, very low, but just make sure you understand that. And the board is responsible for hiring and managing the CEO, and everyone else falls underneath the CEO. There are some nonprofit models out there that have sort of a dual CEO role or a dual leadership role. I've seen that a lot in the performing arts space. So a lot of arts organizations will have a artistic director and a managing director, and those two report up to the board. When that relationship is good between the two, that model can work really well. If those two are not getting along, everything starts to fall apart, as you might imagine. But typically, I think in most cases, you're going to have one CEO. Underneath the CEO, there's going to be a variety of positions, but generally speaking, you're going to see something like this. Someone who's in charge of finance, let's call them the CFO. Maybe it's a director of finance, maybe it's a finance manager. There's someone who's in charge of finance. Underneath the director of finance or the CFO, there's going to be a controller. The controller is the person that's responsible for closing the books. What does it mean to close the books? Basically, what we're talking about here, and this is specific to accrual accounting, is you are making sure that all of your receivables, right, this money that others owe you, and all of your payables, stuff you owe other people, are properly accounted for so that we can prepare financial statements that accurately reflect how the organization is doing. Now, if what I just said sounds a little like gobbledygook, it will start to clarify itself, I guarantee, by the end of today and over the course of the next few weeks. Oftentimes, you're also going to find someone who's in charge of operations. Maybe it's a COO, maybe it's a chief program officer. There's different ways of describing it, but this is the person who's responsible for the operations, generally speaking, programmatically of the work. Then you're going to have someone who's responsible for human resources, right? That's a critical piece. So think onboarding, offboarding, dealing with employee issues, things along those lines. Typically, you're going to have someone in charge of IT, right? Maybe it's part-time, maybe you've got a whole IT team, maybe you outsource it, maybe you hire from within. But you need someone who can, deal with internet issues, technology challenges, right? Making sure that you've got the latest and greatest hardware and software, and dealing with cyber security issues, right? There's a lot these days that are tied to IT. And then the last one is fundraising. One of the things my CEO from many years ago, and you have some of her articles for reading, Clara Miller, who I loved working for and wrote some wonderful pieces back in the day, like to say that every nonprofit runs at least two businesses. And if the first business is your programmatic business, can anyone guess what the second business is? First business is the program, right? The work that you're doing out in the community. What's your second business?
Fundraising?
Fundraising. Yeah. Samuel, is that what you were going to say? I think someone jumped in right ahead of you.
Oh yeah.
Yeah. Fundraising. Fundraising is a line of business. Make no mistake about it. So in terms of understanding your organization's business model, it's also important to understand what the fundraising requirement is, because it will vary in subsectors. The fundraising requirement for federally qualified health centers looks a whole lot different than arts organizations, which look a whole lot different than animal welfare groups, right? There's a lot of different subsectors out there, but there's still a fundraising machine and you have to invest in it. And that's just the reality. It is inescapable. I've worked with thousands of nonprofit leaders over the years through presentations, through one-on-one consultations, and also being in-house as a finance leader. And lots of CEOs would love to not have to fundraise, but it is inescapable. I think I've come across one or two nonprofits that are sustainable through earned revenues alone out of thousands. And typically that's because they, there's a small subset that are able to leverage volunteers in a way that don't require them to fundraise. But otherwise, fundraising is integral, right? Nonprofits exist because there's not a commercially viable alternative, and thus requires third-party payers to come in and fund the difference. So that's also important to know for any of you who are thinking about starting up a nonprofit um, or just being involved in one. Don't fall in the trap of thinking that you can earn your way uh, to the point where you can cover all of your expenses. Fundraising is just an integral part of it. And we'll talk more about that when we get to budgeting and modeling. Okay. Let's move now and talk a little bit about some basic accounting terms. This is not an accounting course, and I'm not going to spend a whole lot of time, but there are some very basics that I want to make sure you have some familiarity with. So one is you'll hear me talk about fiscal year. Fiscal year is basically just the 12-month period that a not-for-profit selects as their accounting year. So for example, at Lifelong, our fiscal year is July 1 through June 30th. That's our fiscal year. It's the 12 months, right? So the first day of the fiscal year is July 1, last day is June 30th. Pretty straightforward. Let's make sure we know the terms. There's also something called the Generally Accepted Accounting Principles, GAAP, right? These are the rules that we apply to record transactions and prepare financial statements, right? So it's GAAP that drives a few things. For example, how we recognize contributions, right? Are they unrestricted or what's now called without restrictions? Are they temporarily restricted and permanently restricted? We've talked a little bit about that. We'll talk some more. It also requires the creation and management of an income statement, also known as a statement of activities or statement of operations, a balance sheet, sometimes called statement of financial position, and then we have a statement of cash flows. We're going to talk about all of these. As a subset of the statement of activities or the income statement, oftentimes there is a subsheet called the statement of functional expenses, which breaks down on the expense side information in more detail so that you can kind of get a better handle of where the organization is spending money. Now, there's different types of accounting practices. Cash accounting is the most simple. If you're a $200,000 organization, you are preparing financials on a cash basis. But there's a problem with a cash basis. It's just cash in and cash out. It doesn't consider a situation where you've been promised money, but you haven't received it yet, or you received a service and you haven't paid it out yet, right? We're going to spend a lot of time talking about receivables and payables. These are some of the core principles, the fundamentals you need to understand. Then there's also sort of a hybrid between cash and accrual. So once you get to like that 500,000, $1 million organization, sometimes they're using something called modified cash basis, which it's like sort of like cash basis with a dollop of accrual in there. Without question, best practice is accrual accounting. But accrual accounting requires more investment, right? You need an accountant. You need to follow those specific rules. A couple other basic accounting terms, capitalization and depreciation. The Berman and Knight book actually does a good job describing this. There are a bunch of estimates that go into capitalization and depreciation, but fundamentally, here's how it works. When you purchase an asset, what's an asset? Like a vehicle, a building, right? Even a high-end computer could be considered an asset. When you purchase that asset, if it has a useful life of more than 1 year and also meets a dollar threshold that's established internally by the organization, what happens is you capitalize that asset. In other words, it goes straight on the balance sheet. So instead of recognizing the full expense of that asset, you depreciate it over time. And we'll dig into that a little bit. So, you know, let's say you buy some medical equipment. What would be a good example? Like an exam chair. Let's say the exam chair costs you $20,000, right? And the useful life of the exam chair, let's say, is 5 years. Let's say it's fully depreciates after 5 years. You recognize on the balance sheet the $20,000, and then on the income statement, it's just the loss of the useful life of that asset using something called straight line depreciation, which we'll talk about in a second. So, okay, yeah, so we're gonna get to depreciation in a second. So let's just double back very quickly to cash versus accrual accounting and make sure that we're lined up around this. So cash accounting is pretty simple. It's like kind of going, enter your ATM card, you go to local bank, you go to Wells Fargo, and you're like, okay, how much cash do I have in? And it'll show you what your balance is and what you spend money on, right? So it's incomes recorded when the cash is received, expenses are recorded when the cash is paid out, and that's it. But that is a limited way of presenting financials. So accrual accounting is preferred because it includes receivables and payables. Receivables is the stuff that others owe you, right? So if you have a commitment from a funder for $100,000, you get to recognize that commitment as revenue, even though you haven't received the cash. That's called a receivable. If you received a shipment from Office Depot for a whole bunch of paper supplies, right? So you've actually received the goods, but you haven't paid the money out to Office Depot yet. You got the invoice, you just haven't paid it. That's called a payable. So the value out of accrual accounting is it provides a more comprehensive picture in terms of how the organization is performing. And that's what we want, right? The purpose of an audit um, and the financial statements that are included in the audit is to give external stakeholders a clear understanding of the financial strength or vulnerability of the organization. And so what we're going to start doing today is looking at those financial statements so that you can cultivate an eye and kind of know what to look for to say, hey, is this organization strong? Is it struggling? What's going on? And what I will tell you, just kind of having taught this class over a number of years, you can really bucket into three categories your areas of focus. One is profitability. Is the organization making money or losing money? Right? And then all of the subsets that are under there. Bung, you have a question.
Yeah, I'm sorry if I missed that, but so when did we count receivables and payables? Like when we send the invoice or when we finish the service or anything?
Yeah, so when I talked about earlier the controller who's responsible for closing the books, part of what they're doing is looking at what commitments have been made in terms of revenues, right? So there's like I actually have an account that's focused specifically on accounts receivable, right? What commitments have been made that we haven't received the cash, and we're going to recognize that as revenue on our income statement. And then the same thing is, what services have we received that we haven't yet paid out, right? Including contractors. Like let's say you had a contractor for the month of, we're in September now, right? So almost done with September. So let's say we had a contractor for the month of August, but they didn't invoice us to early September. Well, we want to recognize the expense of the contractor in the month that they did the work, which was back in August. So that's how that works.
Okay, thank you.
So the three buckets, we've got profitability, right? Are we making money? Are we losing money? The second one, you guys, is critical. It's liquidity. It's looking at cash and reserves. There are many great organizations out there that go out of business not because they aren't profitable, but because they run out of cash, right? So you want to make sure you're looking at liquidity, and there are a few key liquidity metrics that we're going to talk about. And then the last one, which we're not going to dig into so much in this course, and some of the other courses I do spend a little more time on it, is a bucket called capital structure. And capital structure is really looking at your assets. Think like a building, right? Your big assets, and then the liabilities, like your debt, right? How leveraged are you? Can you afford the debt service? Things along those lines. So that's sort of like the next level. But if you can stay focused on profitability and liquidity, it's going to give you a lot of information around where the strengths and the vulnerabilities of an organization is. Okay, let's double back to depreciation. So um, every fixed asset you purchase, assuming it meets a certain dollar threshold. So let's just talk about that for a quick second. how many of you all have printers in your house? How many of you all have printers that you've been using for the last 3 years? Me too, right? Printers are not very expensive these days, are they? You can get a pretty nice LaserJet printer, like, I was actually just at Best Buy yesterday. Like $400, maybe $300. Like there, you can get even some good ones for like $100, right? The printers aren't expensive; they get you on the ink, right? That's how they do it. Now, for a printer that has a useful life of 4 years, right? If you bought it for $400, maybe you're depreciating at $100 each year over the course of 4 years. But because it's so inexpensive for an organization like Lifelong, we would set a dollar threshold, which means even if you have an asset that has a life of, more than 1 year, if it's under, for us, $5,000, we're just going to recognize it as an expense. We're just going to put it on the income statement as an equipment expense. That's just how we're going to handle it. So what it does is it has us focus on the bigger ticket, the more expensive assets that we use to depreciate. And that's just a function of time and effort, right? If we were to capitalize and depreciate every single printer in our 1,200 employee organization, there would be a lot of extra work without a whole lot of extra benefit, right? So oftentimes when we're depreciating, accountants are going to use a what's called the straight line method, or a predetermined useful life for different fixed assets. Buildings oftentimes are between 32 and 40 years. Computers typically will have a 3-year, right? So by definition, fixed assets are being capitalized, which means that the purchase of the asset is not going to show up as an expense on the income statement, but rather it's a balance sheet transaction that then you depreciate. And I realize I'm throwing some concepts out here that are simply introductions. Once we start working through the spreadsheets, this is going to land even more. Gabriella, is that a puppy? Is that a dog you have there? Is that what that is? That is adorable. Is it a pup?
It is.
It is. Okay, can we like take a little puppy break here for a quick second?
Like a pup break.
Oh my gosh, what kind of dog is that?
We have literally no idea, but we had an accidental litter of puppies at our dog rescue, which is like
Oh,
uncommon
wow.
dogs, but somebody came very, very pregnant, and these are her babies now. She's had 4 of them, and this
Oh
one's
my
name is
gosh.
Extra.
All right, I'm glad my daughter is not here. We have one dog who's 9 years old and she's begging for a second one.
This one's
Okay.
perfect.
All right. We always have to take a puppy break. I mean, you just have to do that. All right. So when you look at your income statement, you'll see a line item that says depreciation expense on the income statement. And the depreciation expense is basically the aggregate, the sum of all of the individual assets that have and their depreciation amount for the year. And we'll talk more about that. So what is depreciation? Depreciation is, you'll hear this in the, if you're talking to finance folks, right? It's called a non-cash expense, right? Because you've already purchased the asset. It's an accounting approximation, reflecting the concept that a asset's going to lose value over time, is going to need to be replaced, right? Now, in the for-profit world, depreciation is tax deductible, so there's a tax advantage there. But in the nonprofit space, because we typically pay no taxes unless it's unrelated business income, there's not really an incentive there. So really, it's an accounting approximation of how much an organization ought to set aside to make future fixed assets, future fixed asset replacements in the future, right? So I'm going to skip these slides for a second, and I want to just go to the depreciation exercise because most students pick this up pretty quickly. So let's look at the useful life of a PC computer here. Let's say you purchased a computer for $2,000. That's a nice computer, right? And let's say that your threshold, you're in a smaller organization, the threshold is anything over $1,000. So you're going to capitalize and depreciate this computer, which means when you purchase the computer for $2,000, on the balance sheet, the cash is going to go down by $2,000, and then your fixed assets are going to go up by $2,000. That's the balance sheet transaction, right? And then each year you depreciate it. So let's assume that this computer has a 3-year lifespan. You're using something called the straight line method of depreciation. So the way the process works is you bought it for $2,000, and the assumption is at the end of year 3, you could sell it for about 500. It's called the salvage value. The salvage value is $500, right? So if we take 2,000 and back out 500, we have $1,500 left. Everyone with me on that? Right? So what that means is in year 1, we're now going to take the $1,500 divided evenly over 3 years. In year 1, the annual depreciation expense is $500. The accumulated depreciation in year 1, because it's just the first year, is 500. So now the remaining net book value at the end of the year of this computer is $1,500. You all with me so far? Okay. Year 2, on the income statement, there's still this depreciation expense of $500, but now the accumulated depreciation, $1,000, right? 500 from year 1 plus the 500 year 2 equals 1,000, which means that now the laptop valued, again, it's accounting approximation, $1,000. And then year 3, another $500. Accumulated depreciation is 1,500. Now you have 500 left. Does that make sense? Questions on that? Okay. So let's do this exercise here. Take a minute, do it on Excel, mark it down on a piece of paper. You buy a piece of medical equipment for $20,000. It has a useful life of 5 years. And the salvage value at the end of 5 years is 0. Right? What is the annual depreciation expense? What's the accumulated depreciation? And what's the remaining net book value? Work on this independently, take 4 or 5 minutes, and then we'll come back and discuss, make sure everyone's good with depreciation. Okay? I'm here if there's a question, but I'm going to hide behind, I'm going to turn my video off. But if you need me, just holler. I'm not going anywhere. Okay, folks, do we need another minute? Are we good? I'll give you all one more minute. All right, y'all, let's go through this. So medical equipment purchase for 20,000, assume there's a salvage value of 0 at the end of year 5. What's the annual depreciation expense using straight line method?
4,000.
4,000 in year 1, right? So we have a depreciation expense of 4,000 in year 1. What's the accumulated depreciation in year 1?
4,000.
4,000.
And then the remaining net book value?
16,000.
All right, someone walk me through year 2. Who wants to do that?
I will. I feel so smart doing this.
Who is this? I can't see who's talking.
Venus, hi.
Hi. Oh, there you are. Okay, gotcha. I see it.
Okay, I got 4,000.
In year 2, accumulated
And then
depreciation.
8,000.
Yep.
And then 12,000.
Perfect. All right,
Ah.
let's look at this. Right. So here's what we've got. So depreciation expense. On which financial statement do we book the depreciation expense? Anyone remember?
Balance sheet?
Nope. Income statement. So what I promise y'all, because y'all are quiet and I appreciate someone taking a stab at it. I promise you in the next few weeks, y'all will say in unison, income statement. We're going to spend a bunch of time digging into it, right? So this is income statement is showing up as an expense. The accumulated depreciation is reflected on the balance sheet of now when we, purchase this equipment for 20,000, now it's only worth 16, right? So this is literally how depreciation works. The last thing I'll say about this, y'all, and the Berman and Knight book does a very good job of this, is a lot of finance. I mean, there are some hard-coded numbers in finance, right? So, your personnel expense is your personal expenses, what you pay your people. Your rent is your rent, right? Those things are clear. But there's also a lot of estimates, right? What is the useful life of this piece of medical equipment? Some organizations might be more aggressive and say, we're going to replace it every 3 years. Others might adjust it a little bit differently, right? And the result of that is going to cause your income statement, you're on the expense side, to fluctuate up or down based on the assumptions that you're using. So I just want you all to have some awareness that, sometimes there's an assumption that, okay, all finance is hard-coded data. There are a lot of assumptions and a lot of estimates that go into finance, the preparation of the financial statements. So I just want you all to be aware of this. But good job. Let's move on to the next topic here. Okay. So in terms of rules of accounting, there are 3 buckets that I want you all to have some awareness around. These are 3 categories of contributions and net assets, and this ties back to some of the accounting rules I want to make sure y'all understand. So the first bucket is unrestricted, or what's called without restrictions. There's 2 types of revenues that flow into this bucket: earned revenue and contributed revenue. Earned revenue, think of fee for service, right? If you're an arts organization, it's ticket sales. If you're in healthcare, it's going to be your billable visit, right? Those are the earned revenues. Contributed revenues are grants that are unencumbered or grants that have no strings attached, right? They're general operating support. Then you have temporarily restricted, and this gets to, we talked about this, I think, a couple of weeks ago when we started to look at that income statement, but temporarily restricted funds contributions are donor-imposed restrictions of 2 types. And the 2 types are either timing or purpose. Purpose is pretty easy, right? So Carly, you're the CEO of a nonprofit, and Veronica is a funder, and Veronica's going to fund your youth program to the tune of $100,000. You also happen to run a senior program, right? Can you take that $100,000 for the youth program and apply it to the senior program? You cannot, because it's temporarily restricted per donor intent, right? So you have a responsibility to follow the intent in the donor, and typically that's evidenced by a award letter where it documents what those dollars are intended for. That's a purpose restricted grant. Timing restricted grant means that you're going to get funds over multiple years, right? So Gates Foundation is giving you a $5 million grant to support education efforts, and you can spend $1 million each year over the course of 5 years. One of the challenges with accounting, I'm going to introduce this now and we will dig into this, but it's quite important, is that you are required under these nonprofit accounting rules. I don't agree with this, by the way. I think it complicates our read of financial statements, but you are required to book the entire amount of that multi-year grant in the year it was committed, not when the funds are being used. In the for-profit world, that would be a balance sheet item that moves over to the income statement when the funds have been consumed for the purpose they were intended. In the nonprofit space, it runs through the income statement. So just know that, and we'll talk more about it. The last one is a permanently restricted form of contribution. This is your endowment. And the way a permanently restricted endowment works is you have a wealthy benefactor who's going to give you, let's say, $10 million. That $10 million can only be invested. That's called the corpus or the principal. The interest generated from that $10 million can be used for program activity. Again, as determined by the funder and as evidenced by the award letter. But you can't dip into the principal, right? You get $10 million, you invest it. Let's say that you own a building and you need to replace the roof. You cannot dip into that $10 million. That is permanently restricted. And so only the investment income from that principal, from that initial investment, can be used for program activities. Does that make sense? We're going to talk a little, not a lot, about endowments, but it's, I think, valuable to understand what they are and how they work. Okay. So these are the FASB 116, 117 rules. I'm not going to go through this. This is dreadfully boring stuff, but I want you to have it as a resource if you need it. I do want to talk about the balance sheet, right? So now we're going to dive into some of these financial statements. So the balance sheet also is known in the nonprofit space as the statement of financial position. This is, when I took my accounting class, my accounting instructor described it as, this is sort of like a photo, it's a snapshot. And the balance sheet reflects assets. This is the stuff that you own, right? Your building, your equipment, vehicles, right? If you have cash, right? We actually all have balance sheets. We just, most of us don't take the time to build out exactly what they are, right? So you've got your assets, the stuff you own, and then you've got your liabilities, which is the stuff that you owe. And in the nonprofit world, oh, that's a chair. I thought it was a rabbit. I see this chair swinging back and forth, and it looked like a rabbit ears. Sorry, I don't know if it's my ADHD kicking in. So your assets, what you own, liabilities is what you owe, and then net assets is the difference between the two. Or in the for-profit world, they call it equity, right? So I'm a homeowner, right? So I have a house. I also have a mortgage, right? So the value of the house, based on what I paid for it back in 2017, that would show up on the asset side of my balance sheet, right? Then I took out a mortgage with Loan Depot, got a great rate back when rates were super low, right? That's my liability, that's my mortgage. And then the difference between the two, that's the net assets. That's how that works, okay? And we'll dig into that a little bit more. So one of the things, the way in which the balance sheet is set up, that term is important because you need the balance sheet to balance. So let's do some simple algebra here, right? So your assets minus your liabilities, right? What you own minus what you owe is going to give you your net assets or net worth. Does that make sense? What that also means is that if you move the assets to the other side of the equation, your assets have to equal your liabilities plus your net assets. The balance sheet needs to balance. If it doesn't balance, it means there's some kind of accounting error and you need to go in and fix it. That's the balance sheet. Balance sheet 101. Here it is. Okay. Now, what's interesting when you look at the balance sheet, and this is kind of moves into this topic of capital structure. There's an extent to which capital structure can actually give you some insight into the core business that your organization is in. And this is coming from a slide that, or a article that Clara Miller presented many, many years ago, right? But if you look at each of these organizations or businesses, right, you've got an elementary school, you've got a performing arts center, and you've got an airline. And the asset side of the balance sheet is looking at your cash, right? Your receivables, what others owe you, your plant and equipment, right? Your fixed assets, and any investments other. That's the big common theme here between these three different groups. Jumps out at you.
Plant and equipment make up for the largest amount of
Yeah.
assets.
Yep. Plant and equipment make up, right? So here's an organization that is facility intensive. For most nonprofits, when you're facility intensive, typically that facility is a revenue generating asset, right? And in this case, a private school, right? You're putting butts in seats. That's what you're doing. Performing arts center, same thing, put butts in seats. That's the business model there. Airline, same thing, butts in seats. That's how it works, right? So as we start to dig into looking at these financial statements, there's an enormous amount that can be revealed through looking at or taking a comparative look at a balance sheet. Oftentimes, folks will go right to the income statement, which makes sense, but there's a lot to be learned from the balance sheet. And if you don't believe me, ask Warren Buffett. He talks a lot about that as well. Okay, so now let's dig into the balance sheet a little bit more, right? So the first thing is, you've got the statement of financial position at the top, and then it says June 30th, 2008. That's the fiscal year end, or what's known as FYE. This is the last day of the fiscal year. Remember I said fiscal year refers to those 12 months, so lifelong is July 1 through June 30th, right? So this balance sheet reflects all the stuff that lifelong, this is not lifelong's balance sheet, but this reflects all the stuff that this organization owns, right? The value as of the last day of the fiscal year, all the stuff that it owns, right? Its liabilities, and then the difference between the two. So here's how this works, right? The current assets are things that are cash or easily convertible to cash within 12 months, right? So the most liquid, it goes from most liquid to least liquid, right? So here's cash and equivalents. Then we've got accounts receivable. Anybody remember what accounts receivable are? What's a quick definition of accounts receivable? Veronica, go for it.
Oh, I was gonna not a formal one, but money coming in.
Yeah, right. It's what others owe you. I think between Samuel and Veronica, you guys got that, right? Then you've got prepaid expenses and deposits. Think of like, first month's rent. That's kind of basically what it is, right? You pay that up front. And then you've got your total current assets, right? The things that are cash or easily convertible to cash within 12 months. Then down here, you have your non-current assets or your fixed assets, right? In this case, it's net of accumulated depreciation. We just talked about depreciation. Remember that? Right? So here's the net amount. And then you have your total assets. By the way, just kind of a quick glance at this balance sheet, just looking at the assets. Do you think this organization owns a building? Harry, why not?
Fixed assets is very, very low.
Yeah, $11,000, unless it's like a heavily depreciated asset. It's probably not a building. What probably is it, if you were to guess? What would you guess it is, Harry?
Oh, I don't know. Maybe like look, they could be renting. I'm not sure, to be honest.
Yeah, I guess what I was going to say is like, think of what are some of the other fixed assets that an organization would have, right? Maybe it's furniture,
Cars and
equipment,
furniture,
things like that, right? $11,000. It's a
Yeah.
couple computers, maybe.
Yeah.
A table, stuff like that, right? And so then you've got your total assets. Now, when we move down to liabilities, right, we've got our current liabilities. So if current assets are things that are cash or easily convertible to cash within 12 months, anyone want to venture to guess what a current liability is? So current liability is the stuff that you need to pay within the next 12 months. So here are some line items. Accounts payable. These are your vendors, right? This is the Office Depot supply that came in. They delivered a bunch of notebooks and pens and sticky notes and God knows what else, right? And so you've received the service, but you actually haven't paid them back. So your accounting team is gonna, and your controller is gonna recognize on the balance sheet that you owe $15,928. Accrued vacation, right? So this is for your employees, right? If you leave the organization and you've accrued vacation, you need to get paid out that vacation. That's a monetary asset, right? So, but it gets accrued. It's a liability, right? It's something that you owe the employee. If you take the vacation, you take a week off, that liability goes down. If you decide that you want to leave, you get paid out, right? But that has monetary value. Sick time does not, but accrued vacation does. And then accrued expenses, typically this ties to people, right? So imagine you close the books in the month, but you're midway through payroll, right? So you've basically worked for this organization for 1 week, but you haven't been paid yet, right? You're accruing those expenses. And so there's current liabilities. Now, non-current liabilities don't show up. Why is that? The answer is there are no non-current liabilities. If there were, you would see it here. Non-current liability typically would be something like a mortgage, right? And so when you take your assets and subtract out your liabilities, right, the difference between the two, so 305,928 minus 59,488 is going to be this $246,440. Everyone with me on that? Now, under the rules of accounting is you're required to break down the net assets into different categories. Back in the day, they called it unrestricted and temporarily restricted. Now they call it without restrictions and with restrictions. It's basically just window dressing. It's the same thing. So it's breaking out, the net assets, which is the difference between your assets and liabilities of what's unrestricted or unencumbered and what is temporarily restricted or donor imposed restrictions, right? So this all ties together. Questions on the balance sheet? Cool. That means you all are ready for the exercise. We're going to do this exercise. We'll talk about the exercise and then we're going to take a break. Okay. So here's the exercise. I'm not going to tell you a lot about this organization. All I'm going to do is tell you that this is a balance sheet at fiscal year end 2004 and a balance sheet of fiscal year end 2005, right? So it's a year-over-year comparison. On your assets, you've got cash, you've got receivables. Dollars are in thousands, by the way. So it's not that there's $330 in cash, there's 330,000 in cash. Everyone with me so far? So you've got your cash, you've got your receivables, prepaid expenses, not a lot of money. PP&E, that's your plant, property, and equipment, comma net of accumulated depreciation. Plant, property, and equipment. Then you've got your liabilities, you got your payables, right? Those are your vendors, and you've got debt. This is the non-current liability. Then you've got total liabilities, and then you have your net assets, which is the difference between your assets less your liabilities, again, broken into these categories. Here we have permanently restricted as zero. Typically, you wouldn't see a balance sheet that shows zero. It just would be eliminated, but for the purpose of illustration, I'm including it. Here is your assignment. I want you to take 3 or 4 minutes at the most. I want you to look at the balance sheet and look at what's changing year over year and see if you can get a sense of what this organization has been up to. Okay? We'll take 3 minutes. We'll talk about it as a group right after, and then we'll take a 10-minute break. Okay? I will be here. I'm just going to turn my my video and my sound off. Okay. Let's talk about this. And again, I want to preface it by saying I didn't tell you anything about the organization. Gave you 2 minutes to look at this. What did y'all learn? What jumped out at you in comparing the year-over-year balance sheet? Venus, go for it.
Yeah, so I noticed that there was a jump in the assets, the PP&E. So in my head, maybe they got a new building or some more equipment, and that's showing up.
Perfect. Let's so Venus jumped right in and identify the big driver of change here, right? So plant and equipment went from 900,000 to 1.5 million. Everyone see that? So the assumption is maybe they bought a building or made some significant upgrades to their building, right? What's next? I'm going to do Gabriella and then Harry. I see both of your hands up.
I saw that the debt increased year over year, so it
Yeah,
like they probably took out some kind of a loan to be able to, I assume, make these capital improvements.
absolutely, right? So again, remember that one of the ways it was described to me, and it's kind of stood the test of time, is that, you know, the story is in the numbers. The numbers don't reveal the entire story, but it certainly points to some things. They bought a building, they did some major capital improvement of some sort, right? We don't know the details on it, but there is an additional $600,000 on their balance sheet. Interesting to note that debt went up a couple $100,000, so that might be in part on how they funded it. And what else? Harry.
Looks like they pumped some cash into it, going from 330 to 150. I'm
Right.
not really sure how receivables get. Maybe they've taken money owed and put it
Right.
into the PPE. But also,
Yep.
interestingly, like the payables have gone up, which means they might have done some work on whatever it is, the contractors that they owe or something, maybe.
Yep. Yep. So the payables have changed, but the big thing is cash has gone down, right? And then receivables also have dropped. So it could be that part of the funding behind this building is not just the debt, but also cash. It also might be that their receivables have gone down because they've collected more. Again, we don't know all the details, but we've got some pretty keen indicators about what this organization has been up to. What I find so fascinating is 2 minutes, right? You take a quick look at this, it tells you an enormous amount of what an organization has been up to, right? So this is some of the power behind taking the time to look at not just the income statement, which is what's going to come after the break, but also really digging into the balance sheet. Any final questions before we take a break? Veronica? And then Tang.
So you said that receivables went down because they probably collected more,
They
but
may
the
have,
cash
yeah.
is okay. I'm confused because the cash is lower on the second year.
Yep.
So my
So it could
thought,
be that they both collected and spent those receivables. We don't know, right? Because we're dealing with incomplete information. We're only looking at one financial statement. We don't have the income statement. We don't have cash flows. If we had all three, there's a whole bunch of things we could do. But if I gave you all three at once, y'all would probably hate me because it's just too much information. So I'm trying to break this down. Veronica, it's a really good question, right? So we don't know all the answers to it, but what it means is the money that's owed to them year over year has dropped. So, you know, presumably they collected those receivables, but again, we don't have all the information there. Who else had their hand up? There's one other person, I think. Tang.
Yeah. So do we have any insights behind that there is a decrease in the temporary restricted net assets and I think slightly increase in the unrestricted net assets?
Yeah. So there's a lot to unpack there. We don't really have time to do it now. But the main thing is all buildings are going to fall into that unrestricted net asset category. So just know that there's no such thing as a temporarily restricted building. There is such a thing as a permanently restricted building. Those you want to be very careful with. That's about as restrictive as you can get. But in this case, you can trust that the building less the debt related to the building is going to show up in that unrestricted net asset component, right? Because it's your net assets. All right, let's see where we are with time. 6:21, 6:31. We'll come back and continue the conversation. See you in a few minutes.
So in Beyonce terms, if Beyonce owned 50 mansions, but then owed the amount of 40 of like 2 mansions, her net worth would be 48 mansions, basically. Is this, does this equate to like
I've
the net
never
worth of,
I've never integrated Beyonce into my finance lectures. This would be a first, but I think what you're saying is right.
okay, so like when net worth, like when all these Bill Gates net worth, it's like taking everything he owns and taking away his things that he owes.
That's
And
right.
oh, okay.
Yeah. So if I buy a home for $1 million and I take on a $700,000 mortgage to pay for that home, then the net worth of that home is 300,000 bucks. And so it's the same concept here.
Thanks.
Okay. I'll see you all in 10 minutes and we'll keep the conversation going. All right, everyone, let's go ahead and get started again. Let me just turn the video, sorry, oh, I guess the recording's been on this whole time. Okay. All right, can everyone see my screen? Perfect. All right, let's move on to what's next. So the three financial statements we're really going to be digging into together. Balance sheet to me comes first, right? That's the centerpiece, but there's two others. The second one is the statement of activities. And the statement of activities is what is responsible for driving the expansion or contraction of net assets. And again, I'm introducing this now. We're going to spend the next few weeks digging into this. The other statement, which we're going to spend just a little bit of time on, in part because it's a counterintuitive document, but I do want you to have some familiarity with it, is our statement of cash flows. Statement of cash flows is, sources and uses of cash, where the cash came from and what you spent it on, but ultimately it's driving the change in cash, right? So what happens with the balance sheet is the balance sheet will grow and contract based on the results of these two financial statements, statement of activities and statement of cash flows. Let me explain this in another way. Okay, everyone see these buckets? This is the bucket slide. Remember those net assets on the balance sheet, right? That's broken into these different categories: unrestricted, temporary, and permanently. Y'all with me on this so far? So in the unrestricted net assets, as I mentioned earlier, there are these two types of revenues: earned revenues, fee for service, ticket sales, billable visits, right? Things like that. That flows into the unrestricted bucket. Contributed revenues, these are the general operating support, right? The unencumbered gifts that you get from your funders, also flows into this unrestricted bucket. And then those dollars flow out of that unrestricted bucket to cover the expenses for which they were intended. Go with me so far? Okay, I'm just offering another illustration of what we're talking about, but let me just go through this and it'll make sense. There's also this temporarily restricted bucket. And what happens here, we'll look into this some more. We talked about it a couple weeks ago, it may not be fresh in your mind, is there's restricted revenues that come in. And then there's restricted revenues that go out of the restricted bucket and into the unrestricted bucket through a line item called net assets released from restriction. Why? Because when you release those restricted dollars into the unrestricted bucket, they are used to cover the expenses for which those restricted dollars were intended. Everyone with me so far? And then finally, we've got the permanently restricted. This is the endowment, right? So you typically will be episodically get some endowment funds, right? Maybe it's through a bequest or something like that. Permanently restricted net assets, and then you get the investment income that also goes into the unrestricted bucket. And then out of the unrestricted bucket to cover expenses. Okay. So what I want you all to think about is, if you think of this as sort of the flow of water, it is the income statement that tracks over a period of time, which is 12 months, the flow of the water coming in and going out. That's the income statement. The balance sheet works like this, y'all. On the very last day of the fiscal year, imagine that you turn off all of the spigots. Turn them off, measure what you have in each of these buckets. That's the balance sheet. That's how it works, right? So income statement, you've got revenues flowing in, and then they flow out to cover those expenses. Income statement. Last day of the fiscal year, turn off the water, measure what you got. That's your balance sheet. Questions on that? Pam.
So the income statement is a statement of cash flow.
Nope, those are two different statements.
No?
Yep.
Oh,
So if you
okay.
look back here, statement of activities is also known as the income statement. Cash flows is something different. Statement of activities, and
got
we're going
it,
to look
got
at this
it.
in a second. Yeah, we'll reflect revenues and expenses. Statement of cash flows is basically looking at sources and uses of cash. Gabriel, you have a question?
Yeah, what's the best way to track everything coming and going?
Tell me a little bit more. I want to make sure I understand your question.
Yeah, so like let's say if someone gives you $5 or writes a check, I'm assuming you just got to plug everything into Excel, or are there tools that would out there that already help calculate all of this?
If you're a tiny organization, you might use Excel, or there's an accounting system called QuickBooks, which is ideal for small businesses. Once you get to the size of Lifelong, you're going to use more enterprise type system. We use something called Sage Intacct. It's a powerful tool. So that's kind of quick response. That's kind of how it would look and how it would work. And we'll talk again, this is not an accounting class, but we'll cover different pieces of it. What I will say is I get the question all the time from students, okay, Brent, this was really helpful. Where do I go next, or what do I do next? And an accounting class, if you haven't taken one, would be a great thing to do because it looks at the inputs. We're focused mostly on the outputs, right? The financial statements. Accounting is what focuses on the inputs. Another course, and this is, I know I've got a couple business school students, so you're already taking this, but for the Goldman students here, taking a corporate finance class is, I think, also something that's worth looking into. It's not just about value in business, it's also looking at, how these different financial statements interact with each other. So for what that's worth. Okay. Let's go to the next slide here. So we've talked a little bit about this. I want to look at it again. We've got this now is the statement of activities, right? So this is the income statement. This is reflecting all of the revenues that have come in over this fiscal year, right? And so if we look at it, it says for the year ended June 30th, 2008, if that's the end of the fiscal year, what's the beginning of the fiscal year for this organization? Kobe, you're saying it, just you're muted.
July 1st.
Yeah. I love how dog friendly this group is here, by the way. I really do. I've got my pup, she's right here, and she's 9. She's getting up there now, but she's a little Cocker Spaniel poodle, and she's great. Dogs are always welcome to my classes, especially the virtual classes. Okay. So July 1st, 2007 to June 30th, 2008. Bella, come here. Go sit. Good place. Good girl. So she was growling at something. I don't know what. Okay. So that's the fiscal year, right? Then we're looking at during this fiscal year between July 1st, 2007 and June 30th, 2008, how much revenue came in and how much was spent. If we look back at this slide, right, it's what you're measuring is how much revenue came in and how much was spent, right? That's the income statement. Balance sheet is you're just looking at what you got at the end of the year. Turn off the spigots, measure what you got. So in this case, right, we've got the revenues. I realize there's a little bit of redundancy here, but it's worth going through, right? You've got foundation support, you've got consulting revenue, some earned revenue, individual contributions, other sources of revenue. And then does everyone see this net assets released from restriction? Remember this? Here's the transfer. $1,087,000 comes out of this bucket and goes into this bucket. Same thing here, right? So it's $1,087,000 that's coming out of this bucket and going into this bucket through a line item called net assets released from restrictions, right? Here it is. Why do we transfer these funds? Is because all expenses are accounted for in this unrestricted column, or what's now called without restrictions. So we've got all these revenues, and then expenses are collapsed into this silly category, but this is how we do it. Program, management in general, fundraising, and then you've got your total, right? And then we have the change in net assets. Does anyone remember what change in net assets stands for? It's another term for change in net assets. If you stay close to the numbers and look at what's going on here, what is the change in net assets telling us?
It's like the revenue minus the expenses.
Exactly. It's revenue less expenses, or surplus or deficit, or profit and loss. Let's go back to some of the fundamentals. Are nonprofits allowed to generate profits, y'all? Very good, right? The unanimous yes. Nonprofits are allowed to generate profits. What's the difference between for-profits and nonprofits when it comes to profits? That was a lot of profits in one sentence. What's the big difference?
I think it's about how you distribute the profit.
Exactly, right? So Zoe said it, right? There are no profits don't go to shareholders in the nonprofit space. Why? A snarky question. Veronica, you know the answer, I can tell. No, you're not unmuting yourself? Why do, in the nonprofit space, why do the profits not go to shareholders? Okay, Venus is like, because it's a nonprofit, LOL, I gotcha. Because there are no shareholders. There's no shareholders, right? So what that means is for nonprofits, when those surpluses or profits drop to the bottom line, they can be reinvested back into the business to further the mission of the organization. But there's no shareholders. That's the big difference. Okay. So, tell me this. Did this organization generate a surplus or deficit in this year?
Surplus?
What was the surplus, Thong?
I think because the net assets is positive.
Okay, so let's talk about something real fast here. You see these two last line items here. Can you see my cursor as it's moving? I just want to make sure. And then actually, I think I can use the little, ooh, all these cool things going on here. Not the eraser. Oh, here we go. Spotlight, right? So you see the net assets beginning of the period and the net assets at the end of the period. Which financial statement were we just referring to with respect to net assets? We were just talking about it. Which financial statement? Assets minus liabilities equals net assets. What's that financial statement?
Balance sheet.
That's the balance sheet. These two line items here, y'all, are balance sheet line items. Okay. It is not part of the income statement. Ooh, I can draw. Let's see. Right. So this stuff here, these are all balance sheet line items. Okay. They are not part of the income statement except for the purpose of understanding how this surplus, right, or deficit here and this line here, right, affects the net assets. But the net assets, oh, I guess I have to turn this off now. Uh-oh. The net assets are here. Oh, this like kind of stays around, doesn't it? Right? So what this is telling us is on an unrestricted basis, right? There was this $30,000 surplus. And so therefore it grew the unrestricted net assets on the balance sheet for that year. I should do a little practicing before I put this stuff on here, right? So, oops. So what's happening here, right, is an expansion of the unrestricted net assets. On a total basis, you see the net assets contracting. But let me go back to the original question. Did this organization run a surplus or a deficit? Gabriel, you have a question or comment?
Answer. I was gonna say deficit because I'm looking at change in net assets at the
Very
total
good.
column, and
Yep.
it's the negative 297,000.
Okay, so Gabriel's saying, and wisely so, right? The change in net assets on a total basis is 297,000. So we're saying they ran a deficit for the year. Does everyone agree? Anyone have an alternate point of view? Okay, it's fair. On a total basis, they did indeed run a loss. And if you look at the size of the loss, right, of a $1.4 million budget, they ran almost a $300,000 deficit. That's a 20% negative margin, right? That's massive, right? If you're a board member and you're looking at that kind of loss, you're probably freaking out. But here's the other thing. How did they do on an unrestricted basis? What was the change in net assets on an unrestricted basis?
30,901.
Yeah, so they have a surplus. So which one is it, you guys? Did they run a surplus or a deficit? Because on an unrestricted basis, they got a surplus. On a total basis, they've got a deficit. What's the right answer here? Gabriel's not wrong, by the way, but what's the right answer here? You can't say it depends. I know my consultants out here are like, well, it depends. I mean, it's kind of true, but what's the right answer? Did they run a surplus or did they run a deficit from an operational standpoint? Everyone's looking very carefully. Some people are like virtually averting eye contact so that I don't call on them.
Is it surplus because you want to look at the unrestricted column?
It is surplus because you want to look at the unrestricted column. So take a look at this here. Notice that all of the expenses exist in this unrestricted category. So in terms of the operations, it's this unrestricted category that best reflects how the organization performed on an unrestricted basis. And on an unrestricted basis, they ran a small surplus. Does everyone see that? But Gabriel's not wrong. They did indeed run a $297,000 deficit on a total basis. So here's my next question. How is that possible? How can they run a surplus on an unrestricted basis and a deficit on a total basis? Gabriel, go for it.
I'm looking at the temporarily restricted column where they are, if I was thinking about the graphic you showed, only 758,000 went into the pool, but however, the net assets that were released from restrictions is still negative 1 million or minus 1 million. And so therefore you're left with negative 328 million. And that then falls down into that negative 328 million below.
328,000, but yes, that's exactly right. 328,000, right? So the reason why we have a total loss is because on a temporarily restricted basis, they released 328,000 more than they received in this year. Here's my next question. How is that possible? How in a given year can an organization release more revenues than they received in a year? Bella, go sit. Sit, good girl.
Don't you have to report it like the whole entire amount, even if
we did talk about that earlier, but that's not
sorry.
exactly tied into what we're talking about here, but we were. Oh, that's like a little check mark here. Look at that. Lots of check marks. Okay, sorry. So remember we talked about these net assets earlier, beginning and end of period. On which financial statement do you see the net assets first primarily? What's the primary statement that you see the net assets? Starts with a B, balance sheet. Yeah, right? Okay, so with that in mind, how is it possible that they can release 1,087,000 but only generate 758,000? In other words, they released 328,000 more than they received in this year. How can that be? Kobe.
Could it be because of multi-year grants that are coming into their as
Could
profit?
very well be. And where is the evidence that they may have a previous balance of restricted dollars?
Is it in their other category?
Nope. It's right here. The net assets at the beginning of the period was 395,000. At the end of the period, they only had 66,000. How is that possible? What happened? Let's do some math. How did they get from 395,000 to 66,000?
Because it's a difference between the beginning and the other one.
Yeah, so right. So let's just do the math. If you start off with 395,000 and you subtract 328,000, guess what you get? 66,000, right? So another way of looking at this, it's kind of like, imagine you have a savings account. Think of the unrestricted. I'm kind of having fun with these check marks, right? Think of the unrestricted as your savings account, right? The temporarily restricted, think of it as your checking account, right? And then I'm sorry, I had that backwards. The unrestricted, think of it as your checking account. The temporarily restricted as a savings, right? So the checking account is where all of your activities occur. Savings account is savings, right? At the beginning of the year, you had 395,000 in savings. At the end of the year, you only have 66,000 in savings. Why? Asking just a fundamental question. Why? How do
Do
we get
they-
from 395,000 to 66,000? Andrea, what do you think?
And this is just me taking a stab at this,
Okay.
but let's say that they had multi-year grants and then they had additional revenue come in.
Yeah, no, so all those things are good and you're right about that, but I actually want to go more fundamental. By the way, this is classic because Berkeley students are super smart and so they're like, oh, he must be asking me a higher level question. I want you to stay close to the numbers. What's happening mathematically here? How are we getting from 395,000 to 66,000?
Oh, the change in net assets, right?
Yep, that's
Or
exactly
the net
right.
assets in the support, they add up to make more money than the net assets. So you subtract those two numbers.
Yeah, so we're taking 328,000 out of the 395. It's being transferred over here. Right? So it's kind of like, hey, we got a savings account at the beginning of the year. We had 395,000 at the end. We had 66,000. How's that possible? Well, because in addition to the money that came in, we transferred an additional 328,000 over to our checking account. Okay, so let me bring this home to the key point on this slide. If you're a board member or a key decision maker and you're asking the question, how did the organization perform in this year? This number here, that $297,000 loss, tells a very different story than a $30,000 surplus, doesn't it? If you're the board chair and you're looking at a $300,000 loss on a $1.4 million budget, what might you be saying to the CEO? I'm reading Kobe's lips and it says, what happened, right? What in the world happened, right? Because we just lost $300,000. Oh my gosh, are we going to have to cut expenses? What's going on, right? It's almost like a panic mode, right? Gabriel's saying, yeah, stop spending so much. But on an unrestricted basis, we have a small surplus, right? So when you're reviewing, the reason why I'm taking so much time on this is part of the complicating factors around reading and interpreting nonprofit financial statements. But the point behind this is you want to go to that unrestricted column first, right? Analyze results and then look for some amazement numbers. I'm gonna get rid of all these check marks here and then we're good. Okay, because the unrestricted is really showing how the organization performed operationally. The total is just reflecting what happened operationally and then what happened in this restricted account. And it's adding those two together. Okay. We will revisit this again. If you guys, this is something, I mean, I have sat down with some very senior executives in the financial industry who are board members of charitable organizations who go straight to the total column because that's the rational thing to do and start asking questions about this massive deficit. And I'm like, no, there's a surplus. And they're like, you don't know what you're talking about, right? But I do because we want to go to this unrestricted column. And once it's explained, then people understand they get it. But, you know, these output pages are intended to reflect to the consumer of these financial statements the financial health and the financial performance of the organization. And the reason why I'm spending this time focusing on this income statement is that it's very easy to misinterpret if you don't know how to look at, read, and interpret and analyze the financial statement, this income statement. Okay. Questions on that? Okay. All right. So, I'm not going to get to the three financial statements. Yeah, actually, maybe. No, I'm not. Y'all will hate me. It'll be too much. Okay, so let's just kind of come back to what we've covered today so far, and then we'll wrap up. We've got about 3 minutes left here. So the statement of financial position is also known as what? What's this financial statement? Say it boldly and unapologetically.
The balance sheet.
Balance
Balance
sheet.
sheet. Balance sheet, right? Assets, liabilities, net assets. The statement of activities, right? That's what we're looking at here, influences the expansion or contraction of the net assets on the balance sheet, right? That's what we have here. Statement of cash flows is what we'll talk about when we meet next week. Again, I'm going to provide an introduction into it. We're not going to dig into it too much, but it works in a similar way to the statement of activities, but instead of influencing the expansion or contraction of net assets, it's influencing the expansion or contraction of cash for the year. Any final questions, folks? Okay, I think this is probably a good place to wrap. If anybody has any specific questions, I'm happy to stick around and answer them. And if not, that's okay. I wish you all a wonderful week. We'll connect next week. One of the things I do want to mention again, if folks do have questions or if you want to set up some office hours, I'm happy to do it before or after class, or we can find some time during the week that is mutually agreeable and we can set it up that way. So just want to let you know that I'm available to you sort of outside of the standard class time. Barta, you have a question?
Yes, I saw in the syllabus that